Hi, welcome to Fill the Boot. I'm Lance, and today I want to talk about control. As founders, a lot of us feel like our businesses are our children, and we wouldn't want anyone to grab control of them or take them away from us any more than we would want them to take our kids. That leads a lot of founders to focus on holding 51% control of their companies, but that's not always the best idea. In today's installment, I want to talk about the realities of power and control in a growing startup. It's completely natural for a founder to want to maintain control of their company. Their concerned investor will come in and push them out, or they'll be overruled in some important decision. And that can lead to a focus on maintaining 51% ownership in the company. That's not always possible. Let's consider the case of a successful growing company that's going through multiple rounds of investment, just up through the B round. And remember, some companies go through a lot more than just the B round. So to start with, you own 100% of the company. And each time you're going to give up about 25%. So after the pre-seed, you own 80%. Well, by the time you get to the B round, you're left owning only 32%. And this is really a best case scenario. Getting a B round at all means your company is growing very rapidly. Now, there are different ways of trying to maintain that control even while bringing in funding. Many people know that Zuckerberg manages to keep control of Facebook because he created a special class of shares that he and a few other insiders own that get 10 votes per share while everyone else just gets 1. Now, unless you happen to be running a company as explosively successful as Facebook was in the early years, you're probably not going to be able to convince any investor to go on along with that. Many founders try to hold on to more of the company by setting a very high valuation, because the higher the valuation, the less dilution they experience for the same investment. But this can backfire, because many investors understand valuation and won't invest at all, so you may be unable to raise the funds that you need. Additionally, the smarter the investor is, the less likely they are to invest at this inflated valuation, which means if you do get money, you're only getting it from the least useful investors, and that's not going to help you very much. Another approach I've seen is to really crank down and bootstrap the company, focus on bringing in as little investment as possible. And while this does sometimes work, it can really limit your ability to grow, and sometimes there's only a window of opportunity that you need to thread. And if you don't bring in the money, someone else will be able to raise money and crush you. So you may end up owning a very big piece of a very small pie, rather than making the company as large as it could possibly be, where everyone gets a really big piece of a truly gigantic pie. Let's take a step back and look at how decision-making and control actually happens in a company. It really doesn't have that much to do with ownership. To start off with, most of the decisions are actually made by the employees in the company. To start with, that might just be you, but eventually you will have hired people, and those people will report to the CEO, so you have control of all of those decisions that take place. Now, the next locus of control is the CEO as the executive department. They're making all of the tactical decisions and the high-level decisions about the company. And you're the CEO, so you're making those decisions. After that, there's the board of directors, and the board is what sets the strategy for the company. It's saying what direction you're trying to take the ship. Now, that doesn't necessarily track with stock ownership. In fact, you will often have side letters with investors that determine who gets how many seats. And then finally, you have the shareholders, and all they really get to do is potentially choose which directors sit on the board and decide when to take new investment, whether to sell the company, things that involve change of control and ownership and rights in the stock itself. Those issues don't really come up all that often, so they don't in fact have that much power. So in many cases, you need to be thinking more about the board than the shareholders. But good board members are going to be following their fiduciary responsibilities. They're responsible to the shareholders in the company. Even if you've picked the board member, they may not choose to go along with you. But in my experience, I have never seen a board vote that was less than unanimous. Maybe with some abstentions where someone had a conflict of interest, but I've never seen a case where someone actually voted against an issue. And that's because the boards I've been on have all worked by consensus. We make sure that everyone is in agreement before we take a step. And so, as long as you've got a good board, control isn't as big an issue as you might think. So let's consider a situation where you really do have a contentious shareholder vote, and you're afraid a lot of people are going to go against you. And let's pretend you're in that post-B round situation, so you only own 32% of the shares. So what does that look like? Turns out 51% still isn't all that important. So imagine that everyone votes, and that's really unusual. In most cases, most of the investors I've seen don't actually bother to show up to vote. But suppose all of them vote, and only 30% of them actually agree with you. You still win. Let's look at maybe a more realistic scenario. 45% of the people bother to vote. Literally none of them agree with you, and you still win the vote. Or suppose 75% show up. A lot of people care about this vote, and 20% of them agree with you. 80% vote against you. You still win. 32% ownership in a company is an enormous stake, and it would mean to lose, really everyone has to care enough to show up to vote, and they all have to disagree with you. So, if everyone takes the effort to vote, and they all disagree with you, maybe that should be telling you something. Right? You probably want to step back and rethink your priorities. If everyone disagrees with you and takes the trouble to vote, the problem's probably with you, not them. So it turns out 51% ownership really isn't that critical. 32% is still an enormous control. So the real key is the golden rule. Don't work with jerks. Don't let them on your board. Don't let them invest. Be picky about who you allow to have access to your company, to buy into your dream. And then work collaboratively with those people. They've got good intentions, they all want you to succeed, and if you've all agreed on the decisions you're making, if and when something goes wrong, it isn't your fault. Everyone bought in on that decision, and you'll all work together to get out of whatever trouble you've gotten into. So relax, even with 32%, you have a huge chunk of the company and you're in a really good place. And being obsessed with this issue can set up a huge red flag. It suggests you may not be someone who wants to work collaboratively. It tells investors you're someone who won't take coaching well, and that'll turn off exactly the people that you wanted to bring in. So relax, go out, focus on making your business amazing. There's a lot of things to stress about as a founder. This doesn't need to be one of them, so leave this worry behind. And if you see anyone else who's stressing about this, please share this with them. I'd love to help as many people as I possibly can. Thanks for watching. I hope you found this interesting and useful, and if so, please like and subscribe. Then hit the bell icon to be notified each time new episodes are released. I upload new content every other week, and I'd love to hear from you what other topics you'd like to see me cover. Let me know down in the comments or come visit us at feeltheboot.com. Till next time, ciao!